This is John Paulamy of the Actionable Intelligence Alert. Today is Sunday, February 11th. And in this week's video, I would like to discuss the recent big pullback in the stock market. And I've entitled this week's slides, "Yes, Stocks Can Go Down. What is your plan?" As you can see from this chart, this is the S&P 500 large cap index. Got a short-term chart here that goes back to last fall. And you can see the carnage that we've seen in the stock market over the last couple weeks. We've been down now. Some stocks are down well over 10%, some 20, 25%. And the question is that I keep hearing from a lot of people or seeing being asked is this the end of the bull market? Should I sell my stocks? I don't know what to do. And I have to chuckle because this kind of goes back to what I discussed in an article that I wrote on the website. And the name of the article is "Why You Suck as an Investor." And this is the main topic of conversation that applies this week. So the stock market drops, and right off the bat, people are going, "What should I do?" You mean you don't have a plan? You're just floating along like a cork? Yep, that's what most people do. So we've talked about in the past that the stock market in the United States is overvalued on a historical basis as either the second or most overvalued it has ever been. Let me repeat that. The stock market in the US, even after this plunge, is the most overvalued or the second most overvalued, depending on how you want to measure it, than it has ever been. It has not seen a correction. That means it hasn't pulled back and had a correction of more than 3% for over a year. It's been straight up. Well, not straight up, at a 45-degree angle. I think we could probably say that. We've talked about why the stock market and why asset markets are so overvalued. Central bank liquidity has been pumped into this, trillions and trillions of dollars of currency units, trillions and trillions of dollars of currency units all over the world, not just by the US, have been pumped into the world economy. And they've levitated these asset prices. So when we have an inevitable pullback, everybody panics, even though we've all been discussing this for a while, that this could happen and would happen. You know, it's funny to me that when stocks are going up, everybody's a genius. Everybody's a stock market professional. Everybody's Warren Buffett. Stocks pull back 10%, everybody's biting their fingernails off to the root. So the thing that concerns me and what I want to tell people in this video is, if you're a novice investor, if you have not been through a big pullback, if you do not understand valuation, then you need to get out of the market. You do not know what you're doing. It's like strapping a bunch of bloody chicken thighs and chicken livers to yourself and jumping into the shark tank at one of these aquariums. You simply don't know what you're doing. It goes back almost to like the Bitcoin morons we were talking about. They found a diamond in the street, and all of a sudden they're a professional investor. The stock market's been going up 9 years in a row. You get in the last year or two and think you're a genius. Listen, I'm not criticizing you. I'm not making fun of you. That was me. I used to be like that. You will lose. Read the article on my website, "Why You Suck as an Investor." One of the main reasons is you have no plan. What did you do? Have $3,000 or $5,000 laying around? The stock market's going up, so you figured you'd get into the stock market too? You don't understand anything about how to value things. You don't know where we are in the market cycle. You don't know how to read a company balance sheet. You don't have any knowledge or insight into market history or how the capital markets work, and yet you're a stock market genius. So then you're worried when the stock market drops 10%? Let's connect the dots, guys. Now, my goal isn't here to beat up on you or make fun of you or talk down to you, but you've got to wake up. The market is overvalued. Now, I think that this is just a correction. I think we're going to go higher. I think we're going to have a final blow off top in the stock market. that's going to suck every dumb dollar in. This is a short-term correction. The thing that bothers me about this correction, though, look at how violent and quick it happened. This is a direct result, guys, of the computers and algorithmic trading that goes on. When the selling starts, I mean, as you may not know this, but you can make a lot of money on the downside by shorting stocks also. And that's what these computers do. They're able to use artificial intelligence to determine, especially in these intraday moves where you see these big downdrafts in the red there, when it starts going down, they can execute trades in milliseconds. And that's what the computers do. And they start short selling stocks. That's exacerbating, that's adding fuel to the downdraft. Okay? And that's why you get these big downdrafts very quickly. It's not individual investors sitting around with their Ameritrade account that causes this. This is computer-based algorithmic trading done by computers. And they do not have any emotion. They do not care about you. They do not care about your future or what you're trying to accomplish. So you need to be aware of this. This is akin, in my mind, to living next to Mount Vesuvius in Italy before it blew up. Volcanoes don't just blow up and destroy everybody around them. They rumble, there's earthquakes, there's pre-eruption indications. That's what this is. This is one of the rumblings before the big eruption. This is the time, guys, to come up with a plan. This is the time to understand what's your exit if we get into a bear market. Do you have proper positioning sizing? That means you don't have all of your money in just one or two stocks. What is your plan for position sizing? What is your portfolio size? What is your downside controls, i.e. stop losses? I've talked about it before on the website. I use trade stops. It automates everything. I try to take the emotion out of these things. Trade stops, when you buy the stock, you enter the stock price. You can set the downside. They'll give you a recommendation based on volatility calculations that trade stops does for each stock, or you can manually enter them. So why not, if you have a big profit in like Netflix or Amazon or one of these things, you can go in and say, okay, Amazon's trading at $1,000 a share. I've got a huge capital gain here. I'm up 100%. I'm going to set my stop 15%, 20% below. You might get stopped out. So what? You preserve it. You preserve your profit. No one ever lost money taking a profit. And at these extended valuations, and you see how fast things can happen, you've got to be careful. You've got to have a plan. I'm not telling you that you need to use my calculations for your stop losses or whatever, but you have to have a plan. You cannot afford to get caught up in another 2008 psychotic break in the markets where you're down 50 or 60%, because you will sell at the bottom. If you're a novice investor that's held from a top all the way down to a 50 or 60% low, you will sell, I promise you. You just do not, people just do not, the average person does not have the psychological and emotional makeup to ride it out. Now, I tell people the average person should start in their early 20s or whenever they first get their first paycheck and just put $200 a month into a no-load, low-cost index fund like those offered by Vanguard. And I believe that advice, even when something like this is going on. And you should put the same amount of money in every month for 40 years. And at the end, you'll have 1.5 or $1.8 million, because the stock market over time, with dividends reinvested, goes up about 7 or 8% a year. That's on average. And if you dollar cost average, you'll buy more stock when the market's down, and you'll buy less stock when the market's up. But even people that follow that will do that, they'll still sell when the market goes down 50%. And they'll muck that plan up. So guys, before you start putting your money in the stock market or investments or speculating, you have to assess your psychological and emotional makeup. That is well over half of the game. Probably most of the game. It's easy to figure out what the trend is. It's easy to understand the valuation. These are just math problems. What's difficult is harnessing and controlling the emotions of fear and greed. And that is what separates the successful from the non-successful. Now, as I said, I think that the stock market's overvalued. It is and was overvalued. It still is. You know, when everything was, all stocks were going up, everybody was a genius. Everybody was a professional investor, even though they had no clue what they were doing. They were just riding the wave. The market hadn't had a correction in over a year. It was due. We were well above the 50-day and 200-day moving averages. That's not typical to be that far above these moving averages, folks. And that's what we've done. We've pulled back to the 200-day moving average. And this is pretty positive here on Friday, what happened. I'm not going to get too deep in the technical analysis, but suffice to say that when you have this line, this small line shows you the range that the market traded in during the day. And this white box kind of tells you where it finished off. And this is positive because the market was moving down, you know, severely on Friday, but yet it rallied back at the end, and we had buying come in, and that's typically what you want to see around that 200-day moving average. Now, that doesn't mean that the market's going to snap right back. It doesn't mean the market can't go down further. But look how oversold it is now. We talked about overbought. Look at how oversold it is now. Look at how the MACD is down to a point where it typically, well, at least we would expect to get a dead cat bounce here. We want to see the bounce. We want to see, it's inevitable we will get one, a pullback or a rally. We want to see how far it rallies back. I would expect some over time here, for maybe take a few months, we start working our way this way. But I think that we are going to get a final Bitcoin-like mania later in the year, probably in the summer maybe, final blow-off top that could make new highs. But we'll want to see. We'll want to see in the interim, do we rally back to this level? And if we're not able to breach this as we get back up here and we roll over again, that would not be good. You have to remember something. Bear markets are processes. They don't just go down like this and then just keep going down. That's not how it works. You're going to see, typically what you'll see, that doesn't mean it can't happen, but the odds are that you'll see a rally back up as people say, well, that was it. You know, we're going to put new money to work. They'll rationalize it. And you'd expect to see a pullback or a rally. And what we want to see is we want to exceed the old highs. And that will tell us that we're going to be heading for higher stock prices. If it just comes up here, then rolls over, then it's a reassessment. We got to start talking about making major changes in what we're doing. So like I said, time to make a plan. You know, a lot of people say they're buy and hold investors. I encourage people, the average person, like I said, to just put $200 a month into a low-cost index fund over a long period of time and do not touch it no matter how much the market goes down. Just keep putting the money in. You'll do fine. That's what the average person should do. Okay? But I know you're not going to do that because you're just not. So you're going to invest. You want to be in there. You want to be in the mix. You want to get in the ring. Okay. But buy and hold, don't become buy and fold. If you are on a long-term plan, I mean, people are not that successful timing the markets, ladies and gentlemen. It's very difficult to do. Most people that get involved with trying to time the markets as their way of investing and speculating end up losing money. So if you're not going to do the long-term 40-year plan, 30 or 40-year dollar cost averaging plan, and you want to get in there and mix it up, then you have to be aware of what's going on. You have to understand you're on thin ice right now with the valuations. You know, we will have a bear market. That means a market where stocks go down for a year and a half. Relentless, grinding bear market. They can last longer than that. They can last as long as this bull market lasted. The thing to ask yourself is, what is your plan? I've encouraged people to sit down and write an investment plan. What are you trying to accomplish? Are you trying to save for your kids' college? Are you trying to do something for retirement? Do you just want to try to get rich? Whatever it is, write it down, because that will determine what you'll be doing vis-a-vis your asset allocation. And I mean, if you're trying to save for a retirement or a kids' college education, you shouldn't be buying high-flying FANG stocks like Netflix, Amazon, Google. These things are way overvalued, and they will revert to the mean. That's what my whole investment methodology is about, is contrarianism and reversion to the mean. That's what my whole basis is. And if you're way overvalued, you can see right now, guys, the overvaluations there were way above where we should be. This is what you want to see, just hugging these moving averages. You get way above, they correct. And when they correct, they overcorrect. What is your plan? What will you do? Remember, if you have a 50% loss in your portfolio, it takes a 100% gain to get back to even. A lot of people don't understand that math for some reason. They think, well, I have a 50% loss. That's, 50% of it. No. If you lose half your money, you need to double your money just to get back to even. And we don't want to get back to even. Remember the rules that we talked about, Warren Buffett talked about. I mean, I cite these guys because they're billionaires. I listen to billionaires, not morons on the street or on CNBC that don't have any money. Rule number 1, do not lose money. Rule number 2, don't forget rule number 1. What is your plan? If you have no plan, I can promise you when the bear market comes, when the volcano blows, you will not be prepared. You'll be like those skeletons they found in Vesuvius in the fetal position as the ash covered them. Instead of the people that said, hey, that volcano's rumbling, let's pack up our stuff and get out of here. Now, as I've said before, you're either a contrarian or a victim. Interesting thing. When this whole market turmoil was going on, the uranium spot price didn't even hardly move. Didn't move. This is one of my main things that I'm focused on. Things that are already bombed out, things that are down 90%, things that have no investor interest, there's no one left to sell. It just sat there. The only people that own uranium and uranium stocks, now some of the uranium stocks did pull back quite a bit because they're stocks. And when stocks go down, 90% of the stocks will go down. But the actual commodity price didn't move. The story stayed the same. And that's what I'm trying to beat into your head, guys. You're either a contrarian or a victim. I put up a article this week on the website about CAPE ratios, the 10 most overvalued markets in the world and the 10 most undervalued. It's amazing, but the undervalued markets like Greece, Russia, Egypt, they weren't down 10, 20%. They weren't down. They were off a little bit, but they're already bombed out. There's no one's invested in them to sell them. But those are the ones that those are the ones that are going to do well over time. Reversion to the mean. That's the sensible thing to do. It's right in the article. I give a link to Meb Faber, who wrote articles about this, white papers. He wrote books about it. Other people have too. I've found other folks that have done similar work. And the methodology works. Sell overvalued assets, buy undervalued assets. Simple. But yet people won't do it. So that's the video this week. You got to have a plan, guys. You got to understand what you own. You got to understand what you're going to do. You've got to get your psychology and emotion under control. On the upside, we have fear of missing out. People just jump in. It's so easy just to go open an online brokerage account and just jump into the market with $5 grand, 10 grand, 100 grand. But when it rolls over and the computers take over, instead of fear of missing out, now we have fear of loss. You have to control those emotions. I really recommend reading Reminiscences of a Stock Operator, books about like Jesse Livermore, some of these traders like that, or just go look up the quotes on the internet. And he will talk about this emotion, controlling psychology. Charlie Munger talks about this, Warren Buffett's partner. He has videos online that people have made. He goes and gives speeches or talks and answers questions. He talks about this, how you have to purge your mind of these thoughts that will derail the rational side, that your rational thinking, these emotions will derail your rational thinking. And if you're not doing that, and you're just sitting back, bragging at work in the coffee room about, yeah, my Netflix is up 100%. What a genius I am. When something like happens last week, Now all of a sudden you're hiding under the covers, sucking your thumb, saying, "Mommy, mommy, mommy." And we're dealing with real money here, folks. Your future. It's not to be trifled with. I leave you with a quote that a very famous hedge fund manager was asked. He was a billionaire. I believe, I can't remember the guy's name now, but it was during an interview. This particular individual didn't give interviews that often. And during the end of the interview, he said the same thing that I'm saying. And he said, you know, the average person really doesn't belong in the stock market because they don't know what they're doing, and they're going to end up getting raked over the coals. And he said, the interviewer asked him, what's the biggest reason why the individual investor shouldn't get in the market? And the guy just sat there and thought for about 10 seconds. And he said, because they're competing against me. And that's it, folks. They used to have a show called Pros and Joes, where retired professional athletes would take on average couch potato Joe. I mean, it was hilarious. It used to be on one of these smaller cable channels. It's the same thing. Investing is a craft. It is a skill. It is a profession. You wouldn't try to take your own appendix out. Most of you wouldn't try to build your own house. Most cars today can't be worked on because of the intricacy of the electronics. But yet the average person is going to try to get in there and wrestle with professional investors in the stock market, ill-equipped emotionally, psychologically, and financially. Not a good recipe for success. Get a plan, write it down, and start working on your emotions and your psychology and what you're going to do when we have the next bear market. That's it for this week. Thanks for listening.